This video is sponsored by Noah, an app I used for this video. The first 100 people to visit the link in the description below will get a week for free of the service to listen to articles from The Economist, Bloomberg, and the Financial Times, plus 50% off. You've probably seen at least a few articles now talking about SPACs, the fancy alternative to the IPO that's starting to make waves in financial markets. Despite having been around for decades, investors are now using SPACs more than ever before, bringing a number of notable firms to the public market, from Virgin Galactic to DraftKings to Tesla challenger Nikola. We've even started to see celebrities entering the space, with Jay-Z partnering with a cannabis SPAC in California. Despite its recent popularity, however, the SPAC is not without its flaws. While it can benefit those who organize and carry out the offering, it has a history of disappointing investors. And before you decide to invest in one, you should probably know what it is, how it works, and why they're only now starting to take off. So let's go over the SPAC on today's Pub. Plain Bagel abbreviated? Never mind. When a company with an established business is looking to take its operations to the next level, its founders often consider taking it public. That is, selling all or a portion of their stake in the company to investors in the open market. Doing so can allow the company to more easily raise capital, since they can sell shares to the wider population, rather than relying on a few wealthy private investors. And as a result, the company may be able to achieve growth that was previously not possible. Conventionally, to go public, a company would need to go through what's called an initial public offering, or IPO, making sure they meet all regulatory requirements and eventually debuting their shares on an exchange. The problem is that the IPO process is a pretty painful one for the founders. Companies need to file mountains of paperwork with regulatory bodies, go on lengthy roadshows to court institutional investors, and pay buttloads of money to investment bankers to help them through the process. Underwriting fees alone often take anywhere from 3 to 7% of the raised proceeds, sometimes even more. But what if you could take a company public without spending all your time filing paperwork, marketing your business, and best of all, without paying a fortune to those investment bankers? Enter the SPAC, or Special Purpose Acquisition Company. Here's the basic idea. A manager with expertise in a particular field or industry will set up a shell company with no assets and no core operation. This is our SPAC, and the manager, known as the sponsor, will then go around and try to convince public investors to invest in this new company. Now, the public investors are well aware that this SPAC doesn't have much going on, if anything. But the manager will promise them that if they fund the company, they will go out and find a private firm to acquire with the proceeds raised. If they are successful in garnering interest, the sponsor will then IPO the SPAC. With no assets, it's a much cheaper and more straightforward process than IPOing a proper company. From there, the SPAC will approach the private company they want to take public and offer to buy them with the investor funds raised, also sometimes supplemented with debt. If the private company agrees and investors approve it, then they will merge with the SPAC and take its place on the public market. Voila, you've now taken a private company public without going through the IPO process. Sort of. Now, while a sponsor may have a particular target company in mind when they're setting up the SPAC initially, one of the crazy things about this vehicle is that it's not often disclosed to investors who they plan on purchasing, since doing so would complicate the IPO process. In other words, investors who purchase SPAC shares don't actually know where their money is going to end up. This is why SPACs are often referred to as blank check companies. Investors are more or less funding an unknown initiative, putting their faith behind the skills of the SPAC sponsor to find an attractive acquisition target on their behalf. Another thing worth highlighting about a SPAC on the technical side is that they're often issued with a stock as well as a partial warrant to their initial investors. A warrant is simply a right to buy a stock at some point in the future for a predetermined price. Most SPAC shares start off at a price of $10 a share, and the warrant will often let you buy more shares for $11.50. With the partial warrant simply meaning that you need more than one share, perhaps 2 or 3, to purchase one additional share through the warrant. This warrant is added as an incentive to the initial investors. If the SPAC announces an attractive acquisition and shoots up in price, the incumbent investors can exercise their warrants to buy shares for $11.50, which would be lower than the market price. So that is the SPAC in a nutshell. And it's something that's been around for decades, as we previously mentioned. But it's recently surged in popularity. As of September, over $41 billion has been raised by SPACs, more than the last 10 years combined. Why the sudden interest? Well, it comes down to a few things. For one, in a year where companies have seen their stock prices double and triple after going public, SPACs arguably offer private companies a better method for capturing this value. Because when you think about it, a stock rising after its debut sort of represents a lost opportunity and value for the owners, since that growth represents a higher price they could have sold their initial shares for. Now they're missing out. The problem is that with an IPO, it's usually unclear what the price will be until further down the process. Not to mention that shares are often first sold at a discount to the institutional investors who buy the first batch, largely thanks to their massive bargaining power. With a SPAC, however, the private owners of the company are provided a simple, fixed dollar offer that they can either accept, turn down, or negotiate, meaning they can more easily capture the value of their company through the SPAC, all the while skipping the massive underwriting fees they would normally be paying to the investment bankers. Secondly, with the pandemic currently ravaging the economy, the SPAC is often seen as a less risky route for the private owners. It's unclear whether there will still be demand for new IPOs 6 months from now. So many companies may be more comfortable opting for the faster, lower cost SPAC route than starting the lengthy and costly IPO process, only to find that interest may have possibly dried up by the time they finally hit the stock exchange. But while some are coming to claim that the SPAC is here to replace the old and out of touch IPO process, this alternative is not without its flaws. So before you consider buying a SPAC, make sure you consider the following points. First of all, while SPACs may save the private owners some money, they can still cost investors quite a bit of cash. Sponsors that set up the vehicle often take a large chunk of the company's shares, typically 20%, as a promote for setting everything up. In other words, sponsors treat themselves to a fifth of the company while paying only a nominal amount for this ownership. On a $100 million company, that's effectively a $20 million compensation package paid by other investors. Secondly, many SPACs have a built-in mechanism whereby the funds raised must be returned to investors if the sponsor is unable to acquire a company, within 2 years typically. Now, this function makes sense, and it's there to protect investors and ensure that they see their money put to use rather than sitting around doing nothing. But it can incentivize a sponsor to move forward with an unattractive acquisition. After all, if a sponsor can't find an appropriate acquisition target, they may go for a less attractive company just to make sure they get their compensation. Even if the company ends up flopping, they get more than they would have received if no deal went through. And while investors do get to vote on these acquisitions, they've already put their faith behind the sponsor buying the SPAC in the first place. So they may be inclined to defer their judgment to whatever the manager decides. Finally, the SPAC doesn't have a great historical track record. By bypassing many of the regulatory and legal hurdles associated with standard IPOs, SPACs have attracted many dodgy companies over the years. We've seen instances of SPACs acquiring private firms that have been fabricating aspects of their business, leading to large losses for investors later down the road. On top of this, the SPAC track record for 2020 has been less than optimal. According to Renaissance Capital, SPAC mergers achieved an average return of 13.1% from January 1st to July 21st of 2020, which is a pretty good return, but excluding the big names of DraftKings and Nikola, that average falls down to negative 10.5% compared to the IPO average of 6.5%. So maybe the SPAC isn't as perfect a solution as it's been made out to be by some, but it's nonetheless something we may see more of moving forward. So as an investor, it's important to understand the key features and drawbacks of the vehicle. There will likely be both very successful and very unfortunate SPACs in the future. So as with any other investment, make sure you do your due diligence and consider all benefits and costs if you're considering buying one. Hopefully SPACs start to garner a better, more trustworthy reputation. But in the meantime, be careful with them. While taking a company to market quickly certainly has its pros for the founders, it can be at the detriment of investors if corners are cut in the process. So I'll be honest, before 2020, I had no idea what a SPAC was. Sure, I could guess from the name how it worked, but I never analyzed a SPAC at my workplace, and it's something that never came up in my studies. So I made sure to do the research before putting the script together. And today's sponsor, Noah, actually played a pretty big role in that. Noah is an app that procures and professionally narrates articles, with the goal of helping listeners learn about various subjects in economics, finance, and a number of other topics. The handy thing too is that articles are grouped into series to provide listeners a well-rounded understanding of their subjects of interest. For this video, for example, Noah had a great series called Why SPACs Are All the Buzz on Wall Street, which featured helpful articles on the topic from the Financial Times and Bloomberg. Which, speaking of the publishers, you can see that Noah has a pretty impressive slate of news outlets on its platform, including Bloomberg, The Economist, and Harvard Business Review, all sources that I read regularly as an analyst. It's a really unique audio service that I thoroughly enjoyed using. And if you want to try it out for yourself, the first 100 people to visit the link in the description below or use coupon code BAGEL50 will get 1 week of the premium tier service for free, plus 50% off the annual subscription fee. So if you've been looking for ways to stay informed on the world of investing in finance, I recommend you check out Noah.